Hello, this is Jordan, and this video is being recorded on Thursday, July 29th, 2021. Thank you so much for joining me. If you're watching this on YouTube, please like, comment, and subscribe. And today in this video, I am going to discuss what is going on with real interest rates and gold, because specifically, real interest rates are suggesting that the gold price should be materially higher than where it is now. Now, I came across this chart on Twitter. Shout out to David Finch. And this is a model for the gold price developed by ByteTree. And it is measured from or against the 20-year tips as if that was yielding 0%. I think in real terms, probably. So it basically factors real interest rates and inflation expectations. And so what we can see from this is if you look at where we are now, and this was a day or two ago, it's very comparable to the lows in this data that we saw summer 2018, which is a very significant low for gold, and then at the very end of 2016, also an important low for gold. And so along with today, those three lows were around minus 10 or minus 11%. Based on the model that they have. So this tells us that gold is lagging real interest rates. And I mean, those historical lows, end of 2016, summer 2018, you look at where we are today or a day or two ago. So you go back, you're looking at the last 4 or 5 years, and that disconnect between gold and real interest rates, it has reached a point where it suggests gold should rally. And, we're probably at the start of a short-term rally. Now, I'm going to do a lot of talking in this video, but this is probably the most important takeaway. I think what is happening is the market believes that real interest rates are probably going to rise over the next couple of quarters. Now, I'm not saying real interest rates are going to rise significantly, but they don't have to. If they just rise a little bit, I mean, if real interest rates are minus 4, minus 5%, and they go to minus 3 or minus 2, that is still bearish for gold. I mean, the way markets and trends work, it's all about rate of change and direction. So if the market thinks that real interest rates are going to rise, that is negative for gold. And so I think that's driven by the fact that the market believes that inflation statistically is going to come down next year. And I happen to agree with it. I don't think we're going to see inflation accelerate. I mean, the question is, how much is it going to come down? Will it be sticky? What happens after 22 and we get into 2023? Is inflation going to be sticky? The market doesn't think it's going to be sticky. I think there is a chance that inflation is probably going to be sticky. But, here and now, to me, that is the reason why there has been this disconnect, because the market thinks that statistical inflation is going to come down materially in the next year. And, if the economy is okay, maybe nominal interest rates, maybe they'll go up a little bit or stay stable. So in that environment, the market basically thinks that real interest rates are going to rebound. And if you look at this chart, we have gold there. This is a weekly line chart. We have the real Fed funds rate, which that's a simple calculation based on the CPI. So that's a lagging indicator, but it really works if you're just taking a big picture analysis view. And then we have, which are calculated from the TIPS market, the real 5-year yield in the middle there, and at the bottom, the real 10-year yield. Now, we can see that the real Fed funds rate, that has come down substantially. However, if you look at what happened in 2016, you can see that gold peaked in August, but the real Fed funds rate based on the CPI, that didn't start going up until the very end of 2016. So that, in that respect, that was a lagging indicator. I think it's lagging again. So the real 5-year, the real 10-year, based on the TIPS market, for short term, those are more instructive. And, if we look at the real 5-year yield, which I like to look at, that has come down below the August low. So, I mean, that does suggest the gold price should be higher. However, the real 10-year yield is potentially the most important. And I say that because historically, according to PIMCO, they did a study on this, that gold tended to be closest to the calculations from the real 10-year yield. And if you look at the real 10-year yield, yes, it hasn't really gone up that much since last summer. However, if you look at that, the bottom right in the yellow, until the last couple weeks, it didn't really go below where it was last summer. So it's been volatile, but more or less it's basically gone sideways for a year. Now it's going a little bit lower. So that to me suggests that, maybe the gold price hasn't been that disconnected. But I mean, that could be a reaching comment, because nevertheless, I mean, the first slide that we showed you, it showed that gold was off where it should be quite a bit. So basically, there is a disconnect. In the short term, it's probably bullish for the sector because the rally looks like it's started. But I think moving out in the bigger picture, the next move in real interest rates is likely to be higher because inflation statistically is going to come down. That's just the fact of the matter. And that's why fundamentally gold has struggled over the last year, even though real interest rates have remained really low and they haven't risen that much. Again, the markets care about direction and rate of change, and the trend is and the data is likely real interest rates are likely to move higher. I'm not saying they're going to go positive, but they're likely to move higher. So that's the fundamental explanation. Technical and sentiment, the market got really overbought. It was due for a correction, a sustained correction, and gold's building the handle on this cup and handle pattern. Last summer, it's a 9-year-long cup. That's going to take a lot of time to play out, not 5 years, but it's not going to take only 1 year. And so my last comment is, when you're looking at charts, you have to look at you should look at daily, weekly, and monthly charts. And the monthlies are more significant than the weeklies, which are more significant than the dailies. That's just the way it is. And so if you look at a daily chart of gold now, it looks constructive that gold could have a good rally here, make a lot of progress. If you look at the daily chart, 1900 doesn't look like much resistance. But if you look at the other greater time frames, you can see that's very significant resistance. Look at this monthly chart. Look at the red arrows there at the top. I mean, gold failed at 1900 quite a few times. After this correction began, it rallied back up in the spring, got rejected in June. So that 1900 on the monthly, and also you can look at the weekly and quarterly, it's a very significant resistance. So if you're looking at these longer term time frame charts, they're telling you that this rally is probably not going to go above 1900. I could be wrong. I'll be happy to be wrong, but that's where we are. A short-term rally is underway, but you have to mind the fact there is quite a bit of resistance at 1900, and the stock market is at another new all-time high today. So unless the market corrects, you're not going to have enough capital move into precious metals to push a real breakout move. And, that aligns with what I said about real interest rates and with the fact that the handle on the cup and handle pattern needs more time to play out. So that was a lot to take in. Hope this was informative for you guys. Let me know what you think. Head on over to TheDailyGold.com. You can check out all my free work there. Really appreciate it, and I look forward to doing another video update for you guys in the days and weeks ahead.